Hi everyone, this is Sandeepanand. Paul Samuelson was a Nobel Prize winner in economics in 1970. He authored the largest selling economics textbook of all time. It was called Economics, an introductory analysis that was first published in 1948. He said, investing shouldn't be interesting, it should be dull. It shouldn't be exciting. Investing should be more of like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. And that was a powerful statement from a great economist. Now, I will show you a picture and you tell me which side of the wing you like to be on. Do you like to be on the left side where you're watching a paint dry or grass grow? Or do you want to be on the right side where there is too much adrenaline rush? It's so exciting to track every minute. For example, 20 times in 20 days was the returns made by one stock called GameStop. We all read in the news. And there are many such stocks due to the short squeeze driven by Reddit users. 100K in this stock, GameStop, would have become $2 million. Wow, it's so exciting. It's a roller coaster rider. It has gone down, gone up so many times in the last 3 weeks. Where do you like to be, on the left side or the right side? Now, that'll really determine whether you are a long term investor or a short term trader. Now, what is the driving force for being on the right side? Is it really the FOMO or fear of missing out or the greed of getting rich quicker? There are only two simple emotions in the market, and that's fear and greed. Now, here is what Warren Buffett stated about such kind of raging bull markets and at the peak, what happens really in his letter to shareholders in 2000. This is, I think, applicable to the NASDAQ boom that happened in 2000. Now, here is what he quoted unquote. They know that overstaying the festivities, that is, continuing to speculate in companies that have gigantic valuations relative to the cash they are likely to generate in the future, will eventually bring on pumpkins and mice. But they nevertheless hate to miss a single minute of what is one hell of a party. Therefore, the giddy participants all plan to leave just seconds before midnight. There is a problem though. They are dancing in a room in which the clocks have no hands. So people really do not understand cannot time the exact peak and they continue to dance as long as the music is on and finally realize that it's too late to having pulled out the money or they overstayed the party. Now, this is a very typical to, analogous to the boiling frog syndrome, which we all have heard. That is, if a frog is put in boiling water, it will jump out to protect himself. However, if you place a frog in a pot of cool or room temperature water and slowly turn up the fire, it will not notice a difference and stay there to get cooked. Now, I don't know whether the boiling frog syndrome has been experienced or it's been experimented, but one thing is for sure, the fear of missing out when your friends and neighbors are making quick money in the bull market at the peaks is really true. There is this famous book written by James Pardo called How Buffett Does It, 24 Simple Investing Strategies from the World's Greatest Value Investor. And I've encircled this from the back flip of the page of the book. And this is very profound snapshot. I've encircled the one point here, right, which is practice inactivity, not hyperactivity, because hyperactivity is a real troublemaker and that can erode away the wealth of the portfolio. Success mantra of great investors has been the same. Buffett once quoted, much success can be attributed to inactivity. Most investors cannot resist the temptation to constantly buy and sell because very difficult to do nothing in the markets, just staring at the portfolio. So this is in line with what the French philosopher Blaise Pascal said in 1600s. All of humanity's problems stemmed from man's inability to sit quietly in a room alone. So well said. And most of the problems in investing world at least can be attributed to man's inability to sit quiet with no activity. So what's the conclusion? It is very simple. Long-term investing is really boring. Now, I think when Charlie Munger was asked about the question about the success mantra for investing, he said, "I think the record shows the advantage of a peculiar mindset, not seeking action for its own sake, but instead combining extreme patience with extreme decisiveness." This is what Charlie Munger said.